Good day, everybody. Hope you're having a good day. Today we're going to move into Chapter 13, dealing with the next accounting cycle, which is the payroll and production process cycle. Basically, it's about the payroll cycle and how payroll is influenced as part of recording payroll costs in production costs in manufacturing setting. Just a quick comment on Chapter 12. I have posted the proposed solutions to the discussion cases from Chapter 12. So those three of those, please have a look at those when you have an opportunity. And as well, in today's class, I'll be making you aware of three questions from Chapter 13. Again, three discussion cases for you to have a look at. And again, in about a week's time, I'll post the solutions for those, so you'll have that available for review as well. Okay, and these types of questions, of course, are essentially meant to help you get ready for the final exam and the types of questions that you'll have there. I haven't set the final exam yet. That's going to be coming up fairly quickly in a few weeks from now. But as soon as we get confirm some details from the registrar's office, I'll let you know what's happening with the final exam and what the format of that will be, so you can start preparing for that. Typically, though, in the past, it's been a combination of short narrative type questions, where typically you have to write maybe 2 or 3 sentences, to answer a question. And then, in addition to that, a number of multiple choice questions, which are directed towards the theory that we've been discussing basically from chapters 11 onwards until we finish the course. Okay, so that's a normal format. I'm sure I'll follow that similar type of format this year, so you can give that some consideration as you move forward. And again, if you have specific questions you'd like to ask, send me an email and I'll get back to you. Certainly keep the class apprised of anything that people need to be aware of on a class-wide basis. Okay, so let's move into Chapter 12. Again, the learning objectives, I sort of bypass each chapter because we essentially deal with those as we move through the material. So we'll go right to, this is PowerPoint number 5. So PowerPoint number 5 starts on page 573 in the text. If you want to follow along, and we'll make some reference to that as we go through the case course material today. So since we're talking about the payroll process, we can think about that in terms of the normal type of recording or journal entries that would be made in a payroll situation. So we're going to be debiting wage expense, or some people are paid by salary as opposed to an hourly wage. So however that cost is determined, debit wages is salary expense. Credit cash, if someone's being paid right away, or sometimes we know we have to accrue costs at the end of an accounting period where wages or salaries haven't been paid yet. So we'll talk about accruals. And then again, depending on which country you're in, but most countries have some type of income tax or other types of amounts which are withheld from employees as they work. So there's an actual liability to remit money to the government. So in Canada, for example, as we carry on our work, a portion of our wage has to be remitted to our government for a number of things. We have, of course, income tax that we pay on our earnings. The government takes that money and does various projects with it to run the country. In addition to that, there are withholdings for what we call the Canada Pension Plan. So that's a pension plan where money's put aside. So you pay into that basically your entire working career. And when you come to retire, there's a pension amount that's available to you. It's a small amount. The maximum amount, just to give you a rough idea, is about $1,200 Canadian per month. So about $18,000, $19,000 per year. is what you get out of that pension plan. So certainly, given the cost of things today, you have to save more money than that in order to retire. But that would provide a very basic type of living for one individual in retirement. The issues with respect to payroll, as is mentioned here, the main control objectives. So what is it that we want our payroll system to control? Well, we have a concern first that only the actual employees of the company should be paid, right? We shouldn't be paying people who are not employees of the business. So this goes towards validity, okay? Are the persons being paid actually employees of the company? And we want authorization controls to ensure that only employees of the company do get paid. So authorization and validity are important. And then as well as accuracy, of course, accuracy in determining that people get paid the proper amount, and also that the withholdings to the government for taxes and those types of things are accurate as well. One of the complexities around payroll accounting is the type of payrolls that exist. I already mentioned wages, so that's typically, someone's paid $15 an hour or $17 an hour. Salaries, that's where someone, of course, is paid a flat amount. So, for example, $5,000 a month or whatever that amount might be. But there's all kinds of other payroll systems, right? There's commission payroll, where you get a percentage, right, of what you sell. So real estate agents, for example, in Canada, if they sell houses, they get 5% of the sale price of the house. So that's a commission-based system. There's also something called piece rate. Piece rate is based on the number of items that you produce. You make X amount of dollars per piece. And so you don't see piecework a lot anymore. It's more common many years ago, but it is another type of pay system. So it's the complexity, right, introduced by various payroll systems that can cause payroll to be misstated in the financial statements. And then, of course, with respect to various withholdings, the calculations are very complex. For Canada Pension, for example, for something we call employment insurance. So employment insurance is an amount that we pay into a fund in case we become unemployed at some point and we can draw against that fund. Again, there's calculations for that. Right now, Canada Pension is approximately 5.5% of your gross wages, and employment insurance is approximately 2% of your gross wages. So those two items added together are quite expensive, 7 or 8% of what you're earning. But again, the calculations are complex, so it's easy to make mistakes. In addition, of course, there's other amounts which are withheld from payroll. For example, myself, I work at the university, right? So I'm paying into a faculty pension plan, so there have to be calculations done every time we get paid. A portion of my earnings go into the faculty pension plan. We have a union, essentially, for the faculty called the Faculty Association. So I have to pay dues to the Faculty Association every time I get paid. And so all these various calculations have to be done. And so that's where the accuracy comes in determining the proper amounts of money are going into the proper buckets, basically. Okay? So it's the complexity of payroll which often makes it very difficult. With respect to assessing risk as it relates to the payroll system, again, it mentions the main risk related to payroll is the ownership assertion. So the process should involve payment to individuals, right? And so that's vulnerable to fraud, because if your payroll system is weak, that means you could perhaps add persons to the payroll who are not actually employees of the company, right? So of course, that would be a problem, paying people who are not actually employees. And so one of the key controls that we want to see present in the payroll system is segregation of duties or separation of responsibilities, right? And you may recall, we've talked about that in most of the accounting cycles that we've talked about. It's about separation of duties. And it's something that is often difficult to analyze because you have to actually think through the process, right, that actually occurs, and then say, okay, I have to have different people do different pieces of the process. So it can be quite challenging just to think through the process. But then at the same time, can you afford, right, to have a lot of different people involved in the process? Because that costs money as well, to hire more employees just to have separation of duties. So very often in small businesses, they do not have a good segregation of duties, okay? Because in small businesses, they can't afford to have enough people to have proper segregation of duties. And so in a small business, internal control is usually weak, maybe even non-existent, okay? In a larger business, in a public company for sure, there are very strong internal control systems because those large companies can afford to hire more people to have proper control over your accounting cycles. Right? And so that's typically what you see when you're auditing businesses is very large businesses have strong internal control systems because they have good segregation of duties because they can afford enough people. Small businesses, especially, of course, entrepreneurs, they want to keep costs very low, and so they take more risk with their accounting cycle, and they have fewer people, and that's why in small businesses sometimes you hear about fraud occur, and especially payroll fraud, right? Again, is by having people on payroll who are not actually employees, and then also fraud with respect to typically purchases. So the purchase system we talked about last week, that would be a case of paying suppliers who have not actually supplied goods or services to the business. Right? So by putting a false supplier into your account payable system, you can actually make payments to a fraudulent vendor. Okay, so these are the two most common ways in which fraud actually occurs. Okay. Again, talking about risk assessment for free payroll and the production process. It mentions here, flexibility and judgment is required for production accounting is a main source of risk in the production process. Production accounting, again, is very complex, very detailed, right? And so we know anytime we have complexity introduced in accounting, it creates a situation in which we may be forced to pay more attention to, and we should have better control over it. So some of the complexities in production accounting are explained in this PowerPoint. It mentions transactions in production accounting include allocations, okay? Allocations, essentially journal entries made from materials records, overhead costs, right? How do we allocate overhead to inventory? And then, of course, actually recording proper labor costs to inventory as well. And then the transfer of costs, payroll, raw material to work in process, and then transferring work in process to finished goods, and transferring good costs properly from finished goods to cost of goods sold. And so that entire production process has risk in terms of error, in terms of costs being improperly allocated amongst the different categories. Okay? Now, in the payroll and production cycles, as we've seen in the revenue receivable receipt cycle and the purchase payable payment cycle, all of management's assertions have to be considered when you're looking at the controls and testing the controls in each cycle. Okay, you can't just select one or two. You have to look at all of management's assertions and assess, are there controls in place that satisfy those assertions or not? If there are not, that means you have to do more substantive procedures in the area of the assertions in which internal control is not strong. Okay, so we start next into, you see it says in the PowerPoint, part 1. So the chapter is divided basically into two parts, part 1 being payroll and part 2 being the production process. So we're going to concentrate more on part 1 than on part 2 because part 1 is typically the most important part that you run into in most businesses. Part 2, because it deals with the production process, of course, it only applies to businesses which are manufacturing businesses, right? It wouldn't apply to service businesses, such as law firms, accounting firms, those types of things, because they aren't involved in a production business. But we will, of course, also cover that part of the material in the text. But again, part one, I'll suggest, especially for exam purposes, is more important than part two. So part one, on the payroll cycle, this starts on page 576 in the text. So the typical activities, okay, that are involved in the payroll process. If you go to page, again, 577, actually not 576, you'll see there's a diagram there which talks about the various steps in the payroll process. And you'll see that if we just review that for a minute, at the top of page 577, you see the red button there. It says start here. And then you go to the right. Well, when you first thing you have to do is hire people, right, in your organization. So they should be submitting an employment application when they do that. Personnel departments, sometimes you have to fire people as well. So there should be a notice actually driven by personnel terminating people when that happens. When people are hired, of course, they have to agree to how much they're going to be paid. So if you're in a unionized situation, there may be a union contract in existence. Or if not, then otherwise the pay has to be agreed to between the employee and management of the company. When you sign on as an employee, there's a form that is completed in Canada. It's called a TD1 form, but it's just simply a form which the employee authorizes deductions to be made from their paycheck for things like income taxes, Canada pension, employment insurance that I've already mentioned. Once the compensation is determined, of course, you can start work. And as you attend work, of course, it should be properly supervised, right, in order to make sure you're doing the work in a proper and acceptable way. As you do your work, the cost of having you employed for the hours that you work has to be summarized by the payroll department. And one of the most important records that are produced by the payroll department is what's called the payroll register. So that is just essentially a listing of all the employees in the business, showing the amount that they make each particular pay period. Then for the payroll accounting, in the manufacturing business, of course, that has to be inputted into the production records. So the work in process can be updated, and of course, costs transferred ultimately from work in process to finished goods and cost of goods sold. Once the pay of the people is determined, of course, you actually have to pay them. So in many businesses today, they do pay by check. Most large businesses, though, we know do EFT transfer, or electronic funds transfer. Now, when you're paying people by EFT, of course, that's done through a computer system. So that now means we have to be concerned about computer controls, right? So that can be a very important part of auditing the payroll cycle as well. Once people are paid, of course, then money is going to come out of the company's bank account, right? And that debt to the employees will be extinguished or paid for. And then we start the cycle again. One of the complicating factors in payroll as well, of course, is the fact that people are often paid at different times, right? Some people are paid weekly, some bi-weekly. Some people in some businesses are only paid once a month. And so the complexity of payroll accounting is made worse by the fact that we actually have to determine how often we're going to be paying people. Okay, so it's a very expensive process just to pay people, let alone recording costs. Okay, now as we've done in the other cycles, we need to consider what types of controls should exist in the payroll process. Okay, so on this PowerPoint, which is number 9, this ties into page 577 in the text at the bottom of the page. You'll see the heading authorization. So we'll walk through these various PowerPoints. And again, you can compare these to the other cycles that we've walked through, and you'll see that the types of controls that should exist, the key words are typically used throughout all the cycles, okay? So that's one of the most important things to remember is when you're studying internal control, the types of controls that should exist in each cycle are fairly common. If you look back at the sales cycle we talked about and the purchase cycle that we talked about, you'll see that we talked about proper authorization and we talked about custody. Okay, some of those terms we're going to talk about here in payroll we've seen before. So there's a commonality, right, between all the systems. The detail is different, of course. So how do you have authorization over sales? Well, right, we should have authorization that a sales order shouldn't get issued until we actually have a purchase order from a customer. Right? That's an authorization control in the sales cycle. So an authorization in the purchase cycle, of course, is we shouldn't commit to buying anything until there's a purchase requisition made, right, by an appropriate department. And so the detail of what we talk about is different in each cycle with respect to the documentation, but in fact, the nature of the control is the same. And here we see in payroll, it says we should have authorization controls. So what do we mean by authorization controls in the context of a payroll department? So we should have a personnel department, okay, in a business, which is independent of other functions. So when it says independent, it's really talking about the payroll department. Okay, you should have a personnel department separate from the payroll department. And that department, as we saw on page 577, looking at the diagram, the personnel department should be separate from these other functions, including the payroll department, and they should have the authority for hiring people and for terminating people, right? So it's an independent department, and all large companies have this, right? A personnel department. You can't get hired, right, unless personnel approves it. And when you're terminated, personnel also authorizes that in terms of documentation that they produce. Also, the personnel department, when you're hired, they should be responsible for determining what the amount of pay is. So that will be documented in a letter to the new employee and what the deductions will be, right, from the pay for. So usually the letter to the new employee will just say, we will deduct the standard deductions for income tax, Canada pension, employment insurance, etc., right, as well as other deductions that might be authorized by the employee. For example, in my case, pension plan, right? Okay, now as people are work in terms of authorizing the payroll, as people actually work, right? If you think about a production setting, somebody's working hours, or if they're absent, right? The direct supervisors are going to know about it. So the supervisors in a manufacturing setting should be responsible for verifying the hours worked by persons and whether they've been off on sick leave or not. Why should they be responsible? Because they have the knowledge, right? They're working with the person on a day-to-day basis. In a very large company, right, someone might be hired by the personnel department initially, that's fine. The proper documentation is done there. But the personnel department might never see that person again, right, for many, many years. If you're talking about a large company with 10,000 employees, the personnel department's not going to see that person probably for many, many years. Who is going to see that employee? The direct supervisor, right? So in terms of someone being paid, there should be an authorization where someone reviews the hours worked, right, where the employee says, I worked X hours this week. Or, if I wasn't at work this week because I was sick, right? So depending on the company policy, very often they still get paid even though they're off sick, okay? They get paid a certain number of sick days per year. But someone has to authorize that they should be paid even though they're off sick. So it needs to be someone who's close to that person, right, in terms of the normal operations of the business. So of course, normally that would be your closest supervisor, whoever that is. So we don't want to pay people, right, unless the hours and the rate of pay have been properly authorized. The next control that should exist in payroll, this is on page 578 in the text, it talks about custody. And so one of the most important things to remember when we talk about custody in each of these systems, very often we're talking about custody over documents. But we also talk about physical custody over assets. So both are mentioned here in this PowerPoint. So it mentions custody for the payroll process includes possession of paychecks, right? So blank paychecks. Who controls those, right? They have to be controlled, presumably locked up somewhere, so that people just can't, right, take a bunch of paychecks on one night and start writing out paychecks to themselves and fraudulently putting the name of the CEO or the CFO or whoever is signing the paychecks. And obviously, not only should blank paychecks be controlled, but if people are being paid with cash, right, the actual physical cash has to be controlled. Or if people are being paid by EFT, right, electronic transfer, the codes which are used, right, to transfer funds from the company's bank account to the employee's bank account have to be controlled so that someone can't gain access to those codes and add new codes for employees that don't exist, for example, or change codes perhaps, right, from one person to another. So control over documents, control over assets such as cash, and control over information, right? All of those things talk about the custody aspect. In addition, access to other documents has to be controlled from a custodial viewpoint. Time cards, right? So very commonly in a production setting, time cards are used where people record the number of hours that they worked on a particular task, right? So we don't want those time cards spread around where people can put false hours, right, on the time cards. So whether it's a time card or a time sheet by each individual, we need proper control. So only that one individual, right, can actually record the information on their time card or time sheet. At some manufacturing plants, when you walk into the plant in the day, you take your time card, right, and you put it into a machine that stamps what time you came in. And then when you leave, you stamp your card again in terms of what time you go out. So in that case, the electronic system's recording, right, the number of hours that you're going to be paid for because you were actually present during those hours. But of course, you need to have proper custody over time cards so that someone else can't punch your card for you, right? So someone maybe who wasn't at work today, if a friend, right, took their time card and punched them in and punched them out, that person might still get paid, right? So you need physical control over all of these time records as well to make sure that people don't get paid for hours when they weren't at work. And so when you think about payroll, there's a lot of different, right, aspects of custody. Right? Again, custody over documents, time cards, blank paychecks, custody over assets such as cash, and custody over information such as electronic fund transfer codes. So you start getting the idea and appreciating more, right, why payroll accounting and internal control over payroll is so complex. Okay, controls with respect to record keeping. Again, this is on page 578 in the text. So with respect to record keeping, it mentions the payroll accounting function. So this is the payroll department. This is the department that's accumulating the information to actually pay the people, okay? So that department should prepare the checks and the related tax reports. So when they talk about the tax reports, they're talking about the reports going to the government, okay? In terms of how much people made, how much is being paid to the government for Canada pension, how much is being paid for income tax, how much is paying for EI, etc. Okay. Now, personnel, they mean here, the personnel department. The personnel department should not have authorization or custody responsibility. Right? So personnel, they should not have custody responsibility. Well, if personnel had control over blank checks, personnel could put a false person onto the payroll and then start writing checks to them, right? So that's why the personnel department has to be separated from the custody responsibility, okay? And of course, if personnel can add someone themselves onto the payroll and start having checks issued to that person, right, you wouldn't want that either, right? So personnel has to be separated from actually calculating the payroll for an individual. At least two different people have to be involved in that process. So again, segregation or separation of the actual recording of hours worked, okay, to a person has to be separated from the actual hiring of that person. Periodic reconciliation. Again, this is discussed on page 578 in the text as well. This is one of the most important controls over payroll, reconciliation. And we can talk about reconciliation in a company's accounting records in a lot of different ways. So one of the best forms of reconciliation is what's called the payroll bank account. So we've talked about the fact that if we think about the sales cycle, right, sales, revenue, receivable, receipts, so cash receipts, money received, it goes into the company's bank account. And then for the purchase payable payment cycle, payments, disbursements come out of the company's bank account. Well, how about payroll? Okay, so when it talks about payroll bank accounts, what they're referring to is most large companies have a separate bank account just for payroll. Okay, so the way it would work is the company calculates the total pay for the period. So let's say, for example, it's $1 million is what we call the gross pay. The gross pay is the number of hours worked times the rates, right, that people earn. So that's the gross pay, $1 million. And then let's say we calculate all the deductions, the income tax, the Canada pension, the EI, pension plan, union contributions, etc. And all of those amounts add up to $300,000 out of the $1 million. So that means the employees in total are owed $700,000. Okay. So what companies will do is they will open a payroll bank account and they transfer $700,000 from their general bank account, to the payroll bank account. And then all the payroll checks are issued to the people. So when $700,000 goes into the payroll bank account and people start either cashing all the checks or EFT transfers are done, what should the balance be of the payroll bank account at the end of each accounting period? In theory, it should be zero, right? Because you're transferring into that account the exact amount of the payroll. So once everyone's paid, all that money should be gone. If there's a balance that's remaining in the payroll bank account, it means something's wrong. So if you issue checks to people, right, when you get a paycheck, do you cash your check right away? Pretty well, right? You don't hang on to your check for 3 weeks before you cash it. Most people I know, including myself, when you get a paycheck, you cash it right away. And so, of course, in most businesses, when you get paid right away, large companies through EFT, or many companies still by check, at the month-end date or within a few days after that, the payroll bank account should be zero. If it's not, again, it means checks have been issued, right, but not yet cashed. So you're going to wonder, why is that? Of course, if your payroll bank account went negative, where more money came out of the account than what you put in, that indicates there's some extra checks out there, right, that maybe weren't accounted for in your accounting system. So what's going on there? Now, a good control, of course, over a payroll bank account is the bank account should not be able to go negative. It can only go to zero, right? So once all the checks or EFT transfers have been made, the balance should be zero. You shouldn't be allowed to go negative. Now, people might allow a little bit of negative room, maybe $1,000, but not a lot of money, right? Because again, the theory is the payroll bank account should be zero. If it's going negative, it's indicating there's a problem, right? Because you issued more checks than you transferred into the account in cash. So you'd have to investigate what's going on there. So the typically monthly reconciliation of the payroll bank account is very important to ensure the accuracy of the payroll records. It'll point out discrepancies between the payroll that's been recorded and the amount of actual cash that's gone out of the company. In addition, of course, when payroll is recorded, there's a lot of different records, right, that are produced. So it mentions here payroll tax returns. So a payroll tax return, for example, in Canada, we have something called a T4 summary. So a T4 is a form that all employees get at the end of the calendar year, and we use that information to file personal tax returns. So a company, such as the university, they take all the T4 slips for each employee and they add them up. When they add them up, that's called a T4 summary. Okay, so there's one document produced for the university as an example called the T4 summary, and that shows the total payroll for the entire university, what all the people made in total. So in theory, you should be able to take that total payroll, right, recorded in the T4 summary. That's what's recorded, that's what's reported to the government, so it's got to be accurate. You should be able to take that report and reconcile that report to the payroll expense recorded in the general ledger, right, for the university. Because the total payroll cost being reported to the government should be equal to the total payroll cost recorded in the general ledger. If it's not, it means there's an error somewhere. So this reconciliation, right, if businesses do it, is a very good internal control, because it will point out discrepancies, if there are any, between what was reported to the government and what's recorded in the general ledger. Now, when I was doing auditing full-time, this was actually, most clients did not do this. Okay, they did not compare what was on their T4 summary being reported to the government to their general ledger. So as a substantive test of the accounting records, right, because the client wasn't doing it themselves on an ongoing basis, you cannot rely upon that as an internal control. So I would have the client at the end of the year, as a substantive test of payroll, I would have them reconcile their T4 summary expense. So let's say in a business, their total expense for payroll was $20 million. Reconcile what's on that form, T4 summary, to their payroll expense that's recorded in the general ledger. They should be the same. Now, one problem, of course, I ran into, clients didn't necessarily appreciate this, although they, obviously I was the auditor, so they cooperated and did what I asked. The T4 summary is filed on a calendar year basis, December 31. All client year ends are not December 31, right? So if I had a client with a January 31st year end, I'm asking them to reconcile their T4 summary for December 31 through to their payroll expense for the year ended January 31. So that meant what they had to do was take their total payroll expense recorded at January 31st and reconcile that to what they reported to the government for December 31st, right? So that, as an example, if I was doing an audit of a client for the year ended December 31st, 2020, so that's their calendar year end, okay? The client's year end is January 31st, 2021. I would say take your total payroll expense for the 12 months ended January 31, 2021, and reconcile that to the T4 summary for December 31st, 2020. So the theory of that is you would take the total payroll expense for the 12 months ended January 31st, 2021, deduct the January 2021 payroll just for the month, right? And then add in the January 31, 2020 payroll just for that 1 month, right? And then that total number should equal to what was recorded on the T4 summary for the 12 months ended December 31, 2020. So clients, on one hand, hated doing that because it took a lot of time to do it in a large company. On the other hand, it proved to be an invaluable tool because sometimes we discover errors, right, that had been made in the payroll. So the client, once they did the reconciliation, they were able to find errors that they weren't aware of before. From our perspective as auditors, we use that as a substantive test, right, of the accounting records. So we're taking information from two different sources, right, the T4 summary going to the government and the general ledger. But keep in mind, the T4 summary information should come directly from the general ledger, right? So by reconciling the two, you would find errors. Sometimes it was errors in the T4 summary. Sometimes it was errors in the general ledger, right, that had not been actually corrected yet. So it was a valuable substantive test, right, of the payroll records, and very useful that way. In addition to that, though, in addition to relying on the T4 summary, you can have other reports, right, that you can use. So labor reports in a production business. So what would happen there is, as people work on jobs in a production business, they're recording their time, right? So maybe during the day, I spent 6 hours on different jobs, but I had 2 hours of unassigned time, right? So on my time card, it says 6 hours charged to different jobs, 2 hours unassigned. When you add it up for the week, right, based on a 40-hour week, it might say worked on jobs 30 hours, unassigned time 10 hours. So that's a total of 40 hours, isn't it, on the time card? So you can take the labor report that would go to management and said, okay, Don Jones worked 30 hours on jobs this week, 10 hours unassigned. How many hours was he paid for? It should be 40 hours. Right? You could take that labor report and agree the total hours by individual on a test basis, right, to what the person was actually paid. They should be the same, right? If I get paid by the hour, the total hours on the labor report should equal the total hours for which I was paid. If it's not, it's an indication there's a problem somewhere, right? There's perhaps an error somewhere, either in the labor report that accumulated the hours or possibly in the payroll, right, that I was paid. If the hours don't agree, there's something wrong, right? So we can use all kinds of information on different reports to verify, right, hours paid. Or if I got a paycheck and I'm not on the labor report, why did I get a paycheck, right? If we don't know what the answer is, we have to investigate it further to determine why I got a paycheck. If I didn't work in a week, maybe I was off sick, right? Maybe I was on training, but again, it just points up issues. Perhaps the labor report has to be changed, right, to include time for training and things like this. The total hours, right, on the labor reports should agree with the total hours that I was paid, is the idea. Okay, so this whole idea of reconciliation, because payroll is so detailed, right, especially in manufacturing businesses, again, there's a lot of internal reports that you can use to reconcile data and to discover errors in the accounting system. Okay, now as we've seen in most of the accounting cycles that we've looked at so far, of course, we know in today's world, we use computer systems for all kinds of different things, and payroll is no different, because payroll involves a large volume of transactions, and they are generally very competitive, or sorry, not competitive, repetitive, okay? Large number of transactions, and they tend to be repetitive. Then computer systems, of course, make sense to be used in that type of a scenario because it increases efficiency, right? Okay, so as we have here in the PowerPoint, again, this is on page 579 in the text, there can be audit evidence in various management reports and files produced by the computer system. So what types of records might we be able to access? So the PowerPoint states payroll systems produce numerous reports that can be used as supporting evidence for various assertions. So does an employee exist? Well, go to the personnel file, right? If a person got paid, does that person exist? There should be a personnel file for that person, right? So that's a very common test for existence. Take the pay that a particular person received for a pay period and trace that individual back to the personnel file, right? Persons on the payroll should be in the personnel department file. If they're not, it's an indication someone got paid who hasn't been authorized, right? Maybe that person doesn't exist. Then in terms of timekeeping records, timekeeping records records hourly workers' time, right? How many hours did you work in an actual day? So timekeeping records, if properly approved by a supervisor, can be used as a source of evidence to confirm the number of hours that a person actually worked and that they're paid for. Right? So we might want to confirm, again, the number of hours paid to the number of hours worked, right, according to the timekeeping records. Then payroll register, again, the payroll register for each person, for each pay, shows their gross pay, shows the various detailed deductions, income tax, Canada pension, employment insurance, etc., and net pay, right? So it shows all that data in one computer report. So that information, again, can be useful information to help us perhaps do some analysis. We'll talk about that in a few more minutes. Labor cost analysis, we already mentioned that computer systems, right, accumulate a lot of data for hours of employees by department, for example, hours, just total hours worked, total hours unassigned, right? So all kinds of labor reports, we can use those to reconcile, right, the hours worked per the labor reports to what people are actually being paid. They should be the same. Right? If I worked 10 hours, I should get paid 10 hours. If I'm getting paid for something different, right, then why? Right? It may be an indication there's a problem with the labor cost information. It may be an issue that there's some other reason I'm getting paid, right, other than for the hours I worked. Again, we don't have the answer today as we sit here, but when we look at two numbers and compare them and say they're different, we have to follow up. And then I also mentioned a few minutes ago, of course, using government reports, right? The T4 summary, that's what they're talking about here, individual T4s, and then the T4 summary, which summarizes all the T4s, right? It shows the year-to-date earnings for everybody in the company. You should be able to reconcile, right, that information produced by the computer system to the actual general ledger, right, to ensure that the general ledger is accurate. So all kinds of information produced by computer systems that can help us to determine that the payroll expense in the year has been accurately recorded. Now, the one thing we have to keep in mind, though, is that if we're going to rely on computer reports, okay, that means we have to actually test the computer system. Right? We can't rely on reports generated by a computer system unless we've actually tested the computer system. Now, this is kind of interesting because back when I first started my auditing career, back in the late 1970s, early 1980s, so at the time I was working in Toronto, mostly in public company clients, and they all had large computer systems. And the audit firm I was with, which was one of the big firms today, I won't tell you which one to protect the names of the innocent, okay? But with one of the big firms, and during the course of the audit staff was using various computer reports to verify information, okay? And I often thought myself, what's the basis for which we're using these computer reports? Because we have not tested the client's computer information system. Well, at the time, okay, auditing standards were just sort of getting developed, and there were no standards, right, at that time with respect to work that had to be done on a client's computer information system. And it wasn't until a few years later, I recall, after I had been doing, of course, audits on various companies, that the profession came out with auditing standards that applied to computer systems, right? And exactly what I thought about in my own mind, just the common sense of it, was that the profession came out and said, you cannot rely on a computer information system and the reports generated by it unless you've actually tested the system, right? So this, of course, led to auditors starting to do audit tests on computer information systems. Of course, the issue with all that is, how do you actually do that, right? And that's developed over many, many years. We had initially, for many years, about 25 years or so, we had essentially what was called the black box approach to auditing computer information systems. And what that was, simply stated, is the computer itself was treated like a black box. You couldn't see inside of it, right, because it was black. And so what you did was you took the data that went into the system, okay, and you looked at the information that came out of the system. And if the information going into the system equaled the information coming out of the system, you concluded the system works, right? So for example, if we inputted sales invoices, right, sales data for $1,000, and we generated sales invoices for $1,000, we said input in equals output out, the system is working, right? That's a black box approach to auditing. Well, of course, there's a problem with that, right, in the detail. So, for example, I might input, right, invoices for 100 items at $1 each. So that's $100. But my output, right, is one item for $100. Total dollars agree, but the detail doesn't agree, right? And so that's a small example of the fact that even the dollars agree in and out, the detail doesn't agree in and out. And so auditors, typically around year 2000, some firms started a little bit before that, the late 1990s, but basically late 1990s and coming forward, audit firms started getting in more detail. And this basically happened as well as a result of the Sarbanes-Oxley Act in the United States. Due to the bankruptcy of a big company at the time called Enron, there was a big scandal around Enron, lots of fraud involved, top management fraud, financial statement fraud. And the US Congress got involved in that fraud and passed a new act called the Sarbanes-Oxley Act. So SOX for short, okay, it's often called the SOX Act, Sarbanes-Oxley. So we call it SOX, just so we don't have to keep saying Sarbanes-Oxley. But the SOX Act in the United States said auditors must now test in detail their clients' computer systems. No longer is the black box approach acceptable. You can't say dollars in equal dollars out, it's okay. You have to test input controls. You have to test processing controls inside the computer system itself. Of course, test what we call output controls. But how do you test the processing controls in a computer system? One of the key ways you do that is by running test data. Okay? Take your own data, so the auditor's own data, and have that information processed by the client's computer system, and see if you get the information that you should get, right, from the processing done by the client's computer system. If you do, the system's working, right? Now, using test data, of course, takes a lot of time just to develop the test data, because you have to be able to develop the formats, etc., so the client's computer system can actually process the data, right? So it takes a lot of time and study to actually process data in a client's computer system. Very expensive, and that's why the audits of public companies has basically skyrocketed over the last 20 years, okay, is a result of the requirements of the Sarbanes-Oxley Act as it relates to computer system controls. Very expensive. Audits generally, the fees have gone up 40 to 50% over that 20-year period because of this issue, okay? Auditors have increased liability now as it relates to whether they have done appropriate work on their clients' computer systems or not. But again, because it's very detailed, very complex, you have to have specialized people on your own staff at the audit firms, right, in order to be able to develop, test data, and do other types of tests of control over a client's computer system. So very difficult, very complex, very costly. And of course, all those costs have to get passed along to the clients who want their audits done. Excuse me for a minute, just gonna take a drink of coffee. Okay, so that's a little bit of background on the audit of computer information systems. Again, we'll be talking about that more as we proceed over the next few days. So the next PowerPoint, as we see, and this is similar to the other cycles that we've already talked about, we have to assess control risk, right? And we know anytime we say control risk, we're talking about internal control risk, right? Will the internal control system prevent, detect, and correct material errors in the financial statements or not? If controls are strong, auditors can reduce the quantity of substandard procedures. If internal controls are weak, auditors must increase, right, the substandard procedures that they do. Now, in the payroll cycle, when we look at what are the risks for auditors, the first risk are false or fictitious employees paid, right? So people are being paid who are not real employees of the business. The second risk would be that the company is overpaying, right, for the amount of time worked by the employees. Now, is there a risk about underpaying for time? Not really, right? Because if people don't get paid the proper amount, they're going to complain, aren't they? Have you ever had an error on a paycheck? I have. And so what do? You call up the payroll department and say, hey, you made a mistake on my pay. It should be this or that, right? So you get a correction made. So underpaying of employees is not an audit risk because the employee will complain. But overpaying an employee, right? Will you complain if you've been overpaid? Most people probably not, right? It's just human nature. So from an audit perspective, we have to ensure that false employees are not being paid. We want to ensure that there is control over overpaying for time. And then the next audit risk would be, is there the incorrect accounting for costs and expenses in the payroll cycle? Okay. Again, basically what we're talking about here is the cost allocations, right? Payroll should be added to work in process and then properly transferred, right? From work in process to finished goods to cost of goods sold. Well, we need controls over that cycle to ensure that the costs are correctly recorded, right, in each of those components. Okay. Control assessment. Sorry, I'm just checking something here. Okay. General controls. Now we've talked about the fact that in each accounting cycle, we've had general controls. By that, we talked about the environment, right, in which the controls exist for each particular cycle. And then we look at application controls. The application controls are the detailed level controls that satisfy the audit assertions in each of the accounting cycles that we've been studying. So again, with respect to general control in the payroll cycle, we already mentioned we need proper segregation of responsibilities or segregation of duties, right? Is one of the main controls that we have to see. So as we've seen in the other cycles, if for payroll, we want separation between the authorization of persons being put on the payroll. We want to see custody over the assets, right, over the blank forms, over the information that we talked about a few minutes ago. We want to have control over the recording of payroll to make sure that it's accurate and complete. And we want to see that there's a reconciliation, right, of the various reports being produced within the payroll cycle for internal consistency with each other. Okay. Now, a couple of specific points. Custody of payroll distribution. So that's payroll distribution used to be where a foreman of a plant would actually walk around with checks, right, for the employees and hand them their check for the week. So that's called a payroll distribution. So custody of the payroll distribution, the checks, you want that by persons who do not authorize pay or prepare the actual checks, right? You can't have someone who authorizes someone's pay, right, actually distributing the checks, especially if they're the same person preparing the check itself. Okay, you want all those functions separated. Now, in today's world, you don't have payroll distribution very often, right? In a very, very small business, that might still occur, but it's most businesses, of course, it's done by electronic funds transfer, right? So this is typically an old process that is rarely seen anymore. Record keeping, you want to see performed by payroll department people and cost accounting people who do not authorize people to be put on the payroll or to actually distribute the pay. So again, you want the accounting done by people who are separate from authorizing people to be put on the payroll and separate from people who actually distribute the pay. Because if someone's involved in doing the accounting for payroll, and they can actually authorize someone to be put on the payroll, they might be able to hide that cost, right? By recording the paycheck somewhere in the cost records where someone doesn't see it, right? And in addition, if they're recording costs, but they actually are in charge of actually distributing pay as well, right? Again, they may take a paycheck themselves that they shouldn't and record that expense somewhere else, right? So if they had physical control over a blank check, for example, right, they could make the check out to themselves and then hide it because they're involved in the actual recording function, right, for payroll costs and, of course, in recording cost allocations, okay? So you just want all these things separated, right? Authorization, custody, recording, and reconciliation. So that's, if you ever had an exam question, right, in the payroll area, all you have to really remember are these key words, right? Authorization, custody, recording, and reconciliation. You want to see different. And that's in all the accounting systems, right? So if you went back and look at the revenue system, the purchases system, you'd see the same thing. Authorization, custody, recording, reconciliation, all should be segregated, right? So the theory is the same, regardless of the cycle that you're talking about. Okay, so with respect to computer-based payroll, so that's a few things that we've already talked about today. It mentions here with computer-based payroll, various records and approval exist, signatures may not exist. So various records are produced. We've already talked about reconciliation, but what they're saying here is that payroll might actually get paid without being physically approved by someone, right? And they talk about controls being embedded in computerized computer payroll systems. So this comes back to how do auditors verify that a client's computer system is properly working. So they mentioned CATs. CATs stand for Computer Assisted Audit Techniques. okay, computer-assisted audit techniques. We call them CATs for short. So this is part of how auditors are going to test internal control. They will actually develop a payroll program, right? Develop test data. Part of their test data, they may include an employee who's not a real employee, right? And then they'll insert that data into the client's computer system and see whether the client's computer system recognizes the false employee or not, right? So the test data is trying to trick the computer system to see if it will process a check for a false person. So auditors can, of course, input all kind of information for test data to see if the client's computer system will pick up the error or not. So you might take a person who's a false employee, right, and see if the client's payroll system will process a payment for that person or not. Or you might take a person who is actually an employee but use the wrong employee number, right, to recognize them and see if the client computer system rejects the payment because of having the wrong ID number. Or you may insert the wrong pay number, right, and see if the system picks up that the payroll, right, the pay rate is incorrect, right? So you're going to be developing these computer tests of the client system to see whether a pay can actually be paid for a false person, see if pay could be overpaid or not, and see if the controls in the system itself actually reject, right, the transaction that you're trying to have processed, right? So this is very common in a very large audit clients. We have to test their computer systems to again see if they're generating accurate information and whether the controls embedded, right, in the client's computer system are actually working or not. Right? Unless you actually test them, how do you really know? So again, this has driven up the cost of audits because you need, again, specialized people to do the computer work to actually be able to test the client systems. I remember one audit I worked on earlier in my career where we were just starting to use CATs, right, in an audit environment. And we had a computer audit, they were called CAS at the time, computer audit specialists. And this was a bank company, okay, that we were auditing. And we were auditing the interest expense number and the interest income number. And the first time we took our data and let the client's software process our data to estimate the interest expense for the year, the very first time we ran the data, our interest expense was different from the client's interest expense by over $1 million. And that was material, right? So, of course, what we discovered was, of course, we had to change our test data some more to coincide with the client's computer system, right, in terms of how some of the calculations were being done. So we altered our data, and of course, once we put the altered data into the client's computer system, then we were able to get our interest calculated within about $50,000, right? So we said, given the data, we're going to input that interest expense should be X dollars. When we actually ran the program, our data on the client's program, their interest expense was different from ours by $50,000. But $50,000 was immaterial, okay? So based on that test data that we were using, we were satisfied that the client's computer program was actually calculating interest expense correctly, right? And of course, in most banks, interest income and interest expense are the largest numbers, right, in the income statement. So you're getting a lot of audit assurance by using your own test data to actually do the calculations on the client's computer program and hoping getting the number which is very similar to the interest expense or interest income, right, recorded by the client's own computer system. Okay, the next item that's mentioned here is the internal control questionnaire. And of course, the internal control questionnaire we've seen in the other cycles as well. So we'll turn to the internal control questionnaire, which is right at the end of chapter 13, as it's been in the other Sorry, just enlarge the system here. Oops. Okay, system went out. Okay, so everybody had to, my computer system froze up on me. So I had to go out and come back into the class. So we'll just get us caught up here to where we're at. Okay. We got up to PowerPoint 17, talking about the internal control questionnaire. So in the text, if you could turn to page 618, page 618, 619, 620 shows you the internal control questionnaire for a typical payroll system. And on the left-hand side, halfway down the page, you'll see it says payroll application controls. And the first item it talks about are the environmental or general controls. Okay, just what we were talking about. Go back to the PowerPoint here. On PowerPoint 16, you see general control considerations. So that's what they're talking about in the internal control questionnaire. So if you look at the first couple, first one, are all employees paid by check or direct deposit to their bank account? Right, that would be a general control that you would want to see in a computer system. Two, if a special payroll bank account is used, as we discussed today, is the payroll bank account reconciled by someone who does not prepare, sign, or deliver paychecks? So independent reconciliation, right, of that payroll account, as we talked about today. Right, so the internal control questionnaire is just dealing with the specifics, right? Some of the items we've already mentioned. And then beyond the environment controls, of course, you're going to get into the detailed, or what I call the application level controls. So you'll see here in PowerPoint 18, it talks about the detailed control tests. So if we look at the bottom of page 618, you see it talks about application control assessments. Right, so the application controls are the detailed level controls which test the internal control objectives. Okay, so the internal control objectives. So I just want to just go back to the text to find that for you. So if you go to page 584 for a minute. So on page 584, Exhibit 13-3, you'll see the control objectives for payroll. So on the left-hand side, the general objectives. Recorded payroll transactions are valid and documented. Right? So we already mentioned that payroll validity is an important control. The specific control activities to the right. Payroll accounting is separated from personnel and timekeeping, right? Proper segregation of duties, where we already mentioned. Time cards are approved by a supervisor, right? So someone won't get paid unless the hours have been approved, right? So that would be a control over excess pay, right? So things like this. So the left-hand side on page 584 gives you the various control objectives that you're trying to achieve. And then on page 585, it gives you the detailed control test that you perform to see if the control objectives are being met. Okay, so let's look at one of those for an example. Then we'll go back to the internal control questionnaire in a minute. So on page 585, personnel files and compensation documents. It says select a sample personnel files and A, review personnel files for complete information on employee date, authority to add to payroll, job classification, wage rate, and authorized deductions. Right? So we're testing whether someone on the payroll has a personnel file and whether the proper information is recorded in that file or not. Right? Item 3 under personnel files, it says trace management compensation scheme 2 minutes to verify board's approval. So typically top management has a bonus scheme, right? Depending on profitability of the company. How do we know that bonus scheme has been approved? Well, we need to go back into the minutes of the company to see that the board has properly approved it. Okay? So various types of control tests that we look at over payroll. And then those detailed tests are what's on the internal control questionnaire. So let's go back to page 618 for a minute. On page 618, 619 again, at the bottom of the page, you see application controls. So these are the detailed controls that we're looking for in the client's accounting system. So for example, under validity, it says, are the names of terminated employees reported in writing to the payroll department? Right? Because a person who's been terminated needs to be taken off the payroll, don't they? So that checks are not continue to be made payable to that person. So hopefully the answer to that is yes. And you see the 2 columns there, auditor response and audit file references. So that's where you're referencing to the file where you have audit evidence that that control is actually being put in place. Okay. Now, if it's not being done, then that's a potential internal control weakness. Okay? So the internal control questionnaire is simply used by the auditors to determine in which areas do we have internal controls that are working and in which areas do we have internal controls that are not working. If we answer yes to any of these controls on page 618 and 619, that indicates a control that we might want to rely on. Okay? Again, the controls that auditors rely on are called key controls. Auditors cannot select and verify all internal controls used by management, right? There's too many. So auditors will select the best controls, what they call the key controls that they want to rely on. And when they select those controls, those will be the ones they test and rely on for financial statement purposes. When the internal control questionnaire is completed, if there are answers given which are no answers, right, indicate that there could be a material weakness. And so auditors have to do what's called a weakness investigation test to determine whether a weakness in internal control has resulted in a material error in the financial statements or not. Okay, so weakness investigation tests are done where internal controls are weak. In addition, it may be a decision, if internal control is weak, you might want to do a substantive audit procedure, right, in that particular area where internal control is weak, to ensure, again, that a material error in the financial statements has not occurred. Okay, so during the conduct of an audit, of course, it takes quite a while to complete the internal control questionnaire, but keep in mind, most clients' internal control systems
do not actually change very much, right, from year to year. And so the internal control questionnaires can often be carried forward, right? They don't have to be completed from ground zero every year. They can just be reviewed, right? So you take last year's internal control questionnaire already completed and review it, right, with a client or the appropriate client personnel to make update changes to it as may be necessary in the circumstances. Okay. So the next slide, we already mentioned Exhibit 13-3. So again, this is back further in the text. So we're just going to find the page for you. Again, that's back on page 584, 585. 585 has the detailed control test. And to give you some examples here. So these ones are the same ones that are on page 585. Okay, so you see all those there. We've already mentioned a couple. Are times cards approved by the supervisor, right, would be a common one. Okay, but many of the other controls, of course, are fairly straightforward. So you can review those. Two directions of control tests. So when we test controls, something that we've talked about before is called dual direction testing. Right? Dual direction testing. All that means, of course, is we are testing in two different directions. Well, when we test in two different directions, how do we know if we're going in the right direction or not? So at the bottom of page 584 is where they talk about dual direction testing. Okay? So very often there's a question on the final exam around dual direction testing. And all it means is that you're tracing, right, documents from one area into another. And the question is, are you going in the proper direction or not? Okay. So at the top of page 586, let's look at that for a minute. Okay. So on the top of page 586, Exhibit 13-5, you see the chart that says two direction testing of payroll controls. So you see on the left-hand side, it says payroll files. And the right-hand side says payroll department. So keep in mind, personnel, right, that's where people get hired and fired. Payroll department, that's where the detailed calculations are being done, okay? So if you want to ensure, right, that the proper payroll information is being recorded in the payroll department, in which direction should you trace? You should trace from the sample of payroll files, right, to the authorization files in payroll, right, into the actual detailed records. So the arrow you see goes from the sample on your personnel files to the right, right? So in that case, right, we're asking ourselves, is the information recorded in payroll valid or not, right? So we're going to trace from the personnel file into the payroll records. Then, going the opposite direction, we're going to say for the payroll register, right, is that information correct, right? Accuracy. Well, if we want to test the information that's recorded, we have to trace back to the source information, don't we? So we would take the payroll register. Remember, the payroll register records the gross pay for the individual, the various deductions, okay, from their pay, and the net pay. So we want to determine, are those amounts correct? So is the gross pay correct? Well, we have to trace from the payroll register back to, right, the authorization files in payroll showing the information that we received from personnel, and then trace that back probably to the actual personnel file for that person, which would show their hourly rate of pay, how many hours they're going to work a week, their actual name, etc. Right? So you have to make sure which way you're testing. Right? So depending on what your audit assertion is that you're testing, you'll test, as we see here, to the left or to the right. Okay, that's what they're talking about, direction. Is it to the left or is it to the right? It depends on what your audit assertion is. So going back into PowerPoint 19, It states the test of controls and transaction details are evidence of the reliability of internal management report and analyses, right? Well, that's why we're trying to test internal control, isn't it? To determine whether the internal reports and analyses are reliable. It says, in turn, reliance on these reports and analyses, along with other analytical relationships is what? Substantive tests, right? Substantive tests, right, includes analytical procedures. That's what they're talking about here, okay, and tests of detail. So it says, in addition to reliance on these reports, because we've tested the controls, together with analytical procedures, that's a major portion of the substantive audit of payroll, compensation costs, and labor costs assigned to inventory and cost of goods sold. So what they're trying to say here is when we audit payroll costs, the normal way that auditors audit payroll costs is a lot of reliance on internal control and analytical procedures, okay? A small amount of tests of detail, because you do have to, as we saw on page 584, you do have to test some level of detail in terms of hourly rates and things like this. But most of the work is around testing of internal control. Why is that? Because of one, large volume of transactions, right? Secondly, very repetitive transactions, right? It's the same transaction, payroll after payroll after payroll. So if you did one payroll correct, you're probably going to do all the other payroll correct, right? So you did one right, you do them all right. So that's the assumption in the payroll system. So it's the repetitive nature of payroll combined with the fact that it's done on a very regular basis, okay? And it's computerized, right? So computers themselves normally don't make mistakes. It's people that make mistakes. So we test, right, the internal logic of the computer program to make sure it's functioning as well. So all of these control tests we rely on to produce accurate financial information, and we combine that with analytical procedures. Again, analytical procedures, we said the reason the auditors like to use those is because they're very efficient, right? It's a way to reduce the number of man hours required to do an audit. So that's typically why auditors want to rely on those tests. Okay, we'll go forward to the next PowerPoint. Again, computerized payroll processing. We've already talked about payroll processing and the fact that most of it's done by computer systems today. And of course, we have to test, right, the client's computer system to make sure that it's functioning properly. However, one way to determine that it's not functioning properly is to do analytical procedures, right? So let's say, for example, a good example is the university. Let's pretend that you're auditing the university payroll, okay? I don't know how much it is. I haven't looked at it. So just for a number, let's say it's $20 million. And when we look at that $20 million, how can we analyze it? Well, we could break down that $20 million annual cost by faculty, right? We could say X dollars for the Yodet School of Business, Y dollars for the School of Nursing, right? The medical school is another portion of it. The arts and science program is another portion of it. So we could break down, right, the total payroll by faculty, right? Faculty of law would be another piece. Then we could compare this year's payroll by faculty to last year's payroll by faculty, maybe to the last 2 years. And we should be able to see that the payroll expense by faculty has not changed that much. If it's changed significantly, it's something to look into, right? Because the faculty pay, right, in terms of numbers of people, right, the number of people have grown a little bit across campus, but not much. And how much people being paid, right, has not increased much. So you would think that the payroll costs by faculty would be pretty static, right? Not exactly the same number, but it would be very close. And so we can look at the total dollars in each faculty and say they're consistent. This year is consistent with the last 2 years. So just on the basis of comparison, right, it looks reasonable. Another factor we could do is take the payroll by faculty and divide it by the number of persons in each faculty to get an average payroll per faculty member. Then we could compare that, this year's number to last year's number, maybe the last 2 years' number. The faculty pay by person, in theory, should not change very much because we have the same number of assistant professors, associate professors, full professors as we had, on an ongoing basis. So you would expect the average not to change very much year to year. If it is changing, then it's something to look into. Now it's possible, right? In the audit school business, for example, in a few years from now, there'll be quite a few people retiring. And so as they retire, that means there'll be probably fewer full professors and more people who are younger in their careers, more assistant professors. So the salary costs you would expect would reduce, right? So there may be movements like this, but you can easily explain those, okay? So analytical procedures are very good, okay, test of most payroll systems, okay? Because if there's a material error, you're going to find it through your comparison of payroll costs year to year, not on a total basis, right? You can't compare the total 20 million this year to last year's total, but do some analysis, right? Break it down by faculty, break it down by average cost per faculty person, and then you can compare typically over a 2 or 3 year period and look at trends, right? And are there trends that look unreasonable? If so, they're an indication there could be a problem, right? So you combine analytical procedures with tests of internal control, as we've discussed today, the most important one being segregation of duties, right? And if there's a good segregation of duties in your analytical procedures tell you that the payroll is accurate, that's how auditors, in most cases, for public companies, audit payroll. They don't do tests of detail because it would cost too much money, right? You could say scrap internal control. I'm not going to rely on it at all. I'm going to only do tests of detail, but that would take too much time, right? And of course, auditors would have trouble trying to bill their clients for that much time. So they don't take that approach. Of course, in large businesses, because payroll is such a large expense, management wants to make sure it is properly controlled, right? Management doesn't want one of their largest expenses not to be properly controlled. Right? So, because remember, management's trying to get bonuses, right, based on performance. So they want their major cost inputs to be properly controlled. So this is where auditors, of course, the objective of auditors, right, is for clients to have strong internal control systems. While good managements realize it's in their best interest as well, right? Because a strong internal control system helps to control costs, right? Keeps the organization efficient. And a strong internal control system is one auditors can rely on, which reduces the annual audit cost, right? So there are many reasons why top management should have a strong internal control system. Okay, so again, as we've talked about before in other chapters, in other cycles, we assess the client's internal control. We assess the risk. Is the risk low? If risk is low, okay, if internal control risk is low, it means a client's system of internal control is strong. If a client has a strong internal control system, in terms of substantive tests, auditors can do smaller sample sizes and do some of their substantive tests earlier in the year. Right? They don't have to wait till the end of the year. They'll do some before year end. Again, all on the basis that the client's internal control system will prevent, detect, and correct material errors in the financial statements. On the other hand, if our assessment of internal control risk is that the internal control risk is high, that means there's a high risk that the client's internal control system will not prevent, detect, and correct errors in the financial statements. So auditors must do more substantive procedures. They must do more of the work at the end of the year because they want to take less risk. They have to do more work, larger sample sizes, because there's a greater risk of error. Right? So again, as we've mentioned again today, it's in the best interest of management to have a strong internal control system in order to reduce their annual audit costs. And of course, as well, to ensure that the control system generates as large a bottom line as possible for their own purposes, right, in terms of bonuses, okay? Substantive audit program for payroll, 13-6, Exhibit 13-6, that's on page 587. So again, with respect to doing analytical procedures on payroll, right, if internal control is strong, we can limit our procedures to analytical procedures. So for example, I just mentioned, right, analyzing payroll at the university by faculty, do an average pay by faculty member, right, in each of the faculties, that type of thing. If you look at the bottom of page 587, one other one I would mention is the very first one. At the bottom of the page under substantive audit procedures, you see the first item says analytical procedures. Look at number 1. It says develop an expectation for payroll expense based on your understanding of the entity, including volumes, new product lines, labor union agreements, prior period expenses, etc. So this says the way to audit payroll is develop your own expectation and then analyze the reasons for variance from your expectation. Right? So if I was auditing the payroll from the university, I might say, okay, I'm going to take last year's payroll expense, add 1%. There's been no union contract, no new contract, okay? The old contract said there's a 1% increase per year. So, and the number of people should be roughly the same between last year and this year. So my payroll cost, my expectation would be 1% greater than last year, and that's X dollars. Then I look at the actual expense, and it's Y dollars, so I have a difference, right? I estimated 20 million, but it's actually 20,500,000. Why is that? Right? So I have to analyze the 500,000 difference to determine why there's an actual difference. Okay. So that's in addition to my comparison I mentioned a few minutes ago, developing an expectation is also another way to do an analytical procedure. Over on page 588, in the middle of the page, you'll see the heading. It says tests of detail of transactions and balances. So again, where you feel maybe you can't get enough audit evidence from analytical procedures, you have to do tests of detail. On this part of the questionnaire, they're telling you what the actual tests are that you could do. So for example, it says for payroll and benefits. This is number 4 on page 588. For payroll and benefits, A, scan the payroll journal for large and unusual items and ascertain the propriety of such items. So scan the journal. Well, scanning the payroll journal, you can only do that if you think you can rely on the payroll journal. To rely on the payroll journal, what must you have done? You must have somehow tested the computer system, right, in order to be able to rely on the payroll journal that it's generating accurate information. Then yes, the test of detail will be to just scan, right, just overview it and see if you can pick up anything that looks unusual. 4B says ask responsible payroll personnel about any fictitious employees with unusual contract terms or conditions or unrecorded transactions, right? Have the employees run into anything that looks unusual or not, right? Number 5, for high assessed risk of misstatement. So when you looked at your payroll and you think that the payroll system is weak, that means there's a high risk, right, that the internal control system will not work. What can you do? Select a sample of employee payments from the payroll journal, right? So that's what people were actually paid, and do a number of procedures. Trace the employee name back to the personnel file, right? So is the person that was paid actually an employee or not? Look at the employee personnel file. Number B, agree the pay rate to either a union contract, some type of authorized record, right? So it should be a letter from the employee stating here's what you're going to be paid, or maybe it's covered by a union contract. Right? Either of those would be fine. The hours for which they were paid on that particular pay, again, if they're a production person, you can agree to some type of a time record, right? A time card or some other type of verification. Maybe it's just a report signed by a manager, okay, that you're going to rely on. Okay, so you can see it's actually going back to source documents, right, where you feel that you have to do detailed tests of accounting records to satisfy yourself from an audit assurance perspective that the payroll has been properly reported. Okay, so that gets us up to part 2 with respect to this particular chapter. And I mentioned that I wanted to give you the problems from chapter 13 that I'd like you to look at. So for chapter 13, I'd like you to have a look at discussion case 13-1, 13-4, and 13-5. Okay. Most of these cases involve cases of fictitious employees, but one of them also involves potential overpayment of payroll, and looking at weaknesses of internal control in payroll systems, okay? So it helps you to develop, right, looking in depth and trying to understand a particular business's internal control system to develop your understanding of, what is it that I should be looking for? And again, doesn't matter if you're going to be a professional auditor, that's fine. This helps you do that. But even as a member of management, right? Remember, it's part of your responsibility as a member of management to help the company be effective and efficient, right? Help a company be effective, achieve its goals, and identify places where costs can be controlled and reduced. Well, that's what an internal control system does, right? And a good internal control system develops effectiveness and efficiency. So actually, your goal as member of management and your goal, right, in a company's internal control system are the same. Right? And so that's why we want to integrate your understanding of internal control with ultimately your actual work as a member of management. Right? Internal control, it sort of sounds like one of those accounting things, right? That, yeah, we know what it is, but I don't really work in internal control. But really, every person is part of the internal control system. Right? Every person in management is part of the internal control system because you help make it work or not work. Right? Are you helping to detect and correct material errors as they occur? You should be. Right? That's everybody's responsibility. So again, to some degree, it's a mindset, right, that we're trying to develop in you, together with, of course, the technical knowledge of understanding better what we mean by internal control. Okay? Okay, so we'll stop there for today, everybody. Going on, I think, close to 2 hours now. So I'll stop. Next day, we'll pick it up. We'll move into part 2, okay, to finish off the chapter. Next week, we'll be going into the next cycle, talking about the investment and finance cycle. The investment and finance cycle, actually, you'll find out that we don't put a lot of reliance on internal control in that cycle, okay? And again, we'll obviously talk next week about why that cycle is different than the first 3, right? The revenue receivable receipt cycle, purchase payable payment cycle, payroll and production cycle, very different in terms of our audit work versus the investment and financing cycle. Okay, have a good day, everybody, and we'll see you in a couple days from now on Wednesday. Take care.